Title: Navigating the Storm: Guidance for Long-Term Investors in Market Corrections and Bear Markets. Introduction. In the unpredictable realm of financial markets, long-term investors often find themselves weathering the storms of market corrections and bear markets. As inevitable as these downturns may be, the prudent investor views them not as insurmountable obstacles but as opportunities for strategic navigation. This article aims to provide comprehensive guidance on how long-term investors can adeptly navigate the choppy waters of market corrections and bear markets, emerging with portfolios not just intact but potentially strengthened. Understanding the nature of market corrections and bear markets. Before delving into strategies for navigating downturns, it is crucial to comprehend the distinctions between market corrections and bear markets. A market correction is a decline of at least 10% from the recent peak, often driven by short-term factors such as economic data releases, geopolitical events, or shifts in investor sentiment. On the other hand, a bear market signifies a more prolonged and severe decline, typically exceeding 20%, often fueled by broader economic concerns, recessions, or systemic issues. Strategic asset allocation and diversification. One of the foundational principles for long-term investors facing market corrections and bear markets is strategic asset allocation and diversification. By spreading investments across different asset classes such as stocks, bonds, and alternative investments, investors can mitigate the impact of a downturn on their portfolios. Diversification helps balance risk and return, allowing long-term investors to withstand short-term volatility with a resilient portfolio foundation. Staying the course with a long-term perspective. Amid market turbulence, the temptation to react impulsively can be strong. However, seasoned investors understand the importance of maintaining a long-term perspective. Successful investing is a marathon, not a sprint. Historical data demonstrates that markets have a tendency to rebound after downturns, rewarding patient investors who resist the urge to make impulsive decisions based on short-term fluctuations. Rebalancing portfolios in times of turmoil. Market corrections and bear markets can upset the carefully calibrated balance of a portfolio. This is where the practice of rebalancing comes into play. Periodically reassessing asset allocations and adjusting them back to predefined targets ensures that investors are buying low and selling high. A counterintuitive but effective strategy that capitalizes on market volatility. Selective buying opportunities amidst fear. Market downturns unveil unique opportunities for selective buying. Astute long-term investors view periods of fear and uncertainty as a chance to acquire fundamentally sound assets at discounted prices. Identifying quality stocks or investment opportunities that may have been unduly punished by market sentiment can contribute to long-term portfolio growth. The power of dividends in bear markets. Dividend-paying stocks often emerge as beacons of stability during bear markets. Companies with a history of consistent dividend payments provide investors with a source of income even when capital appreciation is elusive. The compounding effect of reinvested dividends can enhance returns over the long term, reinforcing the resilience of a well-diversified portfolio. Employing defensive strategies. Bear markets tend to disproportionately impact certain sectors of the economy. Long-term investors can consider defensive strategies, such as allocating to sectors with historically lower volatility, including utilities, healthcare, and consumer staples. These sectors may exhibit more stability during market downturns, providing a buffer against broader market declines. Monitoring economic indicators and fundamentals. Keeping a vigilant eye on economic indicators and fundamentals is imperative during challenging market conditions. Long-term investors should stay informed about macroeconomic trends, corporate earnings reports, and other key metrics that offer insights into the health of the economy and individual companies. Understanding the underlying factors driving market movements empowers investors to make informed decisions amid uncertainty. The importance of liquidity management. In times of market stress, liquidity can become a valuable asset. Long-term investors should evaluate their liquidity needs and ensure that they have sufficient cash reserves to cover potential expenses, or take advantage of investment opportunities that may arise during downturns. Maintaining flexibility in portfolio management allows investors to adapt to changing market conditions. Seeking professional guidance. Market corrections and bear markets can be emotionally challenging for investors. Seeking professional guidance during these times can provide a stabilizing influence. Financial advisors can offer objective perspectives, help investors adhere to their long-term financial plans, and navigate the complexities of market cycles with confidence. Conclusion. Navigating market corrections and bear markets requires a combination of strategic planning, disciplined execution, and a steadfast commitment to long-term goals. Successful long-term investors view downturns not as impediments but as integral components of the market cycle. By embracing diversification, maintaining a long-term perspective, selectively seizing opportunities, and leveraging defensive strategies, investors can emerge from market turbulence with portfolios that are not only resilient but positioned for future growth. In the ever-evolving landscape of financial markets, the ability to navigate downturns with poise and strategic acumen distinguishes the savvy long-term investor from the rest, ensuring a resilient and prosperous financial journey.